You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play.
You wanted it. You got it. A radio program that helps teach you options trading inside and out, basic to complex. This is Options Boot Camp. Whether you want to learn how to protect your portfolio, generate income, or even become a master of volatility, your Options Boot Camp drill instructors, Mark Longo and Dan Passarelli, will break it all down for you. Old trading walks into a bar. New trading raises it. That's Tasty Trade. Keep focused with news feeds that matter. See opportunity differently in analysis mode. Chart your heart out with over 300 indicators. Plus, you can get low pricing, lots of education, and a support team that really gets how traders trade. It's no wonder Investopedia named Tasty Trade the best broker for options in 2024. Genius loves company. Go to tastytrade.com/podcasts and see for yourself. Tasty Trade Incorporated is a registered broker-dealer and member of FINRA, NFA, and SIPC. Fall in boot. It's time to get into peak options trading shape. It's time for Options Boot Camp.
All right, everybody, that music means we are back. It is time once again for a little bit of Options Boot Camp, what the cool kids call OBC. My name, of course, Mark Longo from the optionsinsider.com, as well as from the network upon which so many of you folks are binging these days. Remember, check out the Pro if you want to go above and beyond, the optionsinsider.com/pro. It was a wild day, a big meltdown in the market yesterday. We had a great live session, several hours almost, go deep into all sorts of trading going on out there yesterday. A lot of great back and forth with the Pro folks discussing a lot of great trading out there. Oh, I see in the chat, Nichols, awesome live session yesterday. Thanks again. Yeah, it was a good time. I think a lot of people had a lot of interesting ideas, and we were able to walk through a bunch of them, put on some interesting trades as well. If you want to check out all that fun, theoptionsinsider.com/pro is the place to go to learn more options oddities every Friday. Awesome exclusives like Vol Death Matches and about a dozen or so live streams a week. Not much to have fun with out there. And speaking of having fun, it's always fun when we are joined by the black-hatted one himself, Daniel McCarthy Passarelli III, Esquire. Weirdly enough, little known fact, named after Joseph McCarthy. Apparently, Dan's family, not big fans of the communists. Mr. Dan, we all learned a little something about you today. So what's going on?
Not too much, Mark. Not too much, Mark.
People forget about the big red scare of Frankfurt that ripped it apart in the 50s and 60s, sir.
It's true. Those were the good old days.
The good old days when you were just hunting commies down in the hinterlands of Frankfurt. All right, Mr. Dan, it's that time of the month, sir. It's time to give away some fabulous prizes. Are you ready? My random number generator is generating. Are you ready, sir, to make some choices, to change some lives, change one life for the better, and make a whole bunch of other people really mad at you? Are you ready, sir? Are you ready to do that? Always ready to infuriate. Hence his middle name, McCarthy. All right. Here we go, listeners. The random number is generating. Mr. P, you tell me when to stop. Up to you.
All right. Ready, set, stop.
All right. Bam. Mr. P has taken a break from hunting down the last known communist stronghold in Frankfurt just to join us here on the show today. Who did you pick? Oh, speaking of McCarthy, you picked Miss McKenzie. I'll have to go check with our producers to see if she's won. She's one of our longtime listeners. I don't know if she's ever won a pro trader. Well, that's awesome. Excellent choice, sir. She's one of our hardcore crypto fans as well. She was very early advocating for crypto in the pro chat. So that's awesome to see her. Congrats, Miss Mackenzie. Mr. McCarthy picking Miss Mackenzie today. Who knew all the wild fun that was going on? We got some wild fun in store for us, Dan. Let's get to it. A little bit of the old options drills.
Call in, Boots. Time for our favorite pastime, option drills. We're going to take the strategies learned during the show and teach you how they can be employed to achieve a specific objective. Do you hear me? Yes, sir!
All right, everybody, welcome to the options drills, where we take a strategy and kind of do a little bit of a deeper dive into. We're actually going to do a bit of a combo, basic training and options drills today, because we're going to do some basic exploring of a strategy, but then we're also going to do a little bit more nuanced, deeper dive into it today as well. And what are we talking about today? We are talking about the much heralded, super hot back in the day, then they kind of cooled off a little bit. Maybe they're getting hot again. We'll find out. It's the Iron Condor. Dan, when I say Iron Condor to you, what springs to mind, sir?
I think of some tried and true stuff to trade. A tool in the toolbox that you don't need every day, but it's always there as an old stalwart.
Or maybe do you need it in the toolbox every day, Dan? That is the subject of our options drills today. I was inspired by this question from Tragic Tim. I don't know why he's tragic. I kind of want to do a whole episode diving into his tragedy, but that's a conversation for another day, Mr. Dan. He just writes in to say, is the Iron Condor the ultimate 0-day strategy? And Dan, you and I were talking recently on the show about maybe taking another look at option strategies we've discussed in the past, but through the lens of 0-day. And Tragic Tim has teed us up nicely here, talking 0-day condors. I think we'll get into that, Mr. Dan, because who knows? Maybe at the end of this episode, we're all going to need an Iron Condor in our toolbox every day. What do you think, Dan?
We just might.
All right. Let's get into a little bit of fun. We have talked Iron Condors on the show. Obviously, we've been doing it for coming up on, it might actually be, I'll have to go look. It might be right at, or maybe next week, because we're recording two this week. It is a doubleheader. It might be right at our 13-year anniversary, which is wild. So we obviously have touched on Iron Condors in the past. Most recently, we did it in October of last year, Dan, which might be our best title of an episode we've ever done. Episode 360, The Iron Condors of Dr. Caligari. A great episode title. We did touch on Iron Condors there. I think it was in response to a listener question like this. We didn't do a deep dive then. We also touched on episode 334 from April last year, Iron Condors, futures options, and Washington skullduggery. Again, another listener question about Iron Condors. We did a bit of an overview back in 2022, September of 2022, when we recorded live from your mastermind session, Dan, episode 203 and 204. These were the great Iron Condor Renaissance episodes 1 and 2. But even then, we didn't do a bit of a overview and a deep dive into them. We kind of just talked about some interesting use cases, which, again, there are even more interesting use cases. But before we get there, like we said, it has been a while. In fact, I went through the archives. I don't know if I ever found a specific example we walked through of an Iron Condor. So if that's the case, we're going to do one now. Listeners, let's go out to the world of Iron Condors. Again, the magical world of XYZ. Listeners, and let's say XYZ is trading right around 100. Nice round numbers. Now we're going to look at it through the short Iron Condor lens. That's the primary use case a lot of people are adopting it for. You can obviously flip this around and go the other way as well. But Iron Condor trading at $100. You think, probably over the next month, it's going to be pretty range bound with, let's say, between 95 and 105. So you look at it, there's a lot of different things you can do if you have that outlook. First off, the 100 call, the 100 put, in our example, trading the exact same amount, 250 each. Of course, in our examples, I like to keep the numbers nice and straightforward. So 250 each. That means that at the money straddle, if you wanted to sell it, would get you $5, aka 5%. Not a bad return for a month, but also a heck of a lot of risk. More risk than you're willing to take on in our example, listeners. So what else can you do that allows you to maybe harvest some juice, but do it in a little bit more risk mitigated way? Maybe that lines up a little bit better with that trading range we just outlined earlier. That's where the Iron Condor comes in. Well, first off, you look out, you think, it might dip to about 95. The 95 puts are trading for $1 in our example. You say, you know what, I could sell that. So you sell that 95 put. You also look up above and say, I think it probably won't get up to 105, so I'm going to sell the 105 calls as well. Also in our example, trading for $1. Again, not real world numbers, but making things nice and straightforward. So you just collected $2, but you also have a whole bunch of naked short risk, net short units that we've always argued against here on this show, especially when you're talking naked calls to the upside. Always a risky prospect. So you listened to this show and you said, what? I don't want to be net short units. I'm going to buy something against this, make this a more risk mitigated trade. So you look out, the next strike available in our example are going to be the 90s. The 90 puts and also the 110 calls, $5 beyond what you already sold. In our example, they're each trading for a quarter. And you say, what? I'm going to buy those just in case the worst case scenario comes to pass. I don't get wiped out on this one trade. So what have you done now? You sold the 95 put for $1. You sold the 105 call for $1. So you sold a $5 out of the money strangle and collected $2 for that. Then you went a little bit beyond that and you bought the 90 put and you bought the 90 call for 25 cents each in this example. So now you sold one strangle for $2. You spent 50 cents on another one. What have you done? You have net now collected $1.50 total premium. Guess what? You just sold your first Iron Condor. That's exactly what an Iron Condor is. You can look at it a couple of different ways. You can look at it as a put spread and a call spread both in the same direction. So you're selling the put spread and you're selling the call spread both out of the money. Or if you're buying it, you're buying both. Or in this case, you can also look at it as selling one strangle and then buying a farther out of the money strangle to hedge it. So there's our example. You collected $1.50 total. And then now what is your risk in this trade? Obviously, you sold $5 spreads. Both of those spreads are not going to be in the money at the end of the trade. Only one of them can be. So your max risk is only the width of one of those spreads. So it's $5. So you collected $1.50. Your total max loss on this trade is $5. But remember, you collected $1.50 for it. So your actual max risk on this trade is $5 minus $1.50 or $3.50. So if you look at it from risk reward perspective, this example is actually pretty juicy. You're not going to find a lot of examples in the real world, and we're going to walk through some in a second, that are this juicy. You're not going to risk $3.50 to make $1.50 very often. It's going to be usually a lot less than that. So you're talking nearly half, 43%, risk to reward here on this. That's not a bad trade in this scenario. Dan, what are your thoughts on our example so far and the use case of Iron Condor, sir?
There's a couple of things that I like about this example. And one of them is just how you look at it as two strangles or, what you could call a strangle swap, if you will. I think a lot of people just view them as credit spreads, which is also an excellent way to view them as two credit spreads. I kind of like the idea of kind of doing both. And the other thing I really appreciate about how you did this example is to look at it from a risk reward standpoint, like a return on capital standpoint, which I think is often something that gets lost on people also.
Now, Dan, there's a lot of different subjective things that come into the Iron Condor. Most notably, it's how do you choose your range? A lot of people like to use that at the money straddle as a way to set their range. I know that's how Overby likes to do it and a lot of his examples out there as well. In fact, it's not an accident, listeners, that our Iron Condor begins right at the max of the straddle as well. It's a good way if you're looking for a decent little rule of thumb for how far out should I go to sell my Iron Condor. I don't really want to have a ton of risk with this, but I also want to have a nice balance between risk and reward. I want to make some premium for it. I don't want to sell it for nothing, but I also don't really want to get my face ripped off. Then the at the money straddle is usually a decent starting point. Some people like to also go one standard deviation. That pretty much lines up pretty much with the at the money straddle. Half a dozen one, 6 the other. But that's a good way to kind of nice little rule of thumb if you're wondering how far apart, how wide should I set my Iron Condor. That at the money straddle is a nice rule of thumb. You can obviously also use some technical analysis level that you've discovered that you think works for you. But for a lot of people, that's how they set them up. Dan, how do you like setting up, I should say, your Iron Condors?
I'll tell you what, Here's one point where I have a different perspective from what you're talking about. I don't like the using standard deviation. I find it to be so completely arbitrary, and any advantages so offset just by the nature of the options pricing model, that I feel it's much better to use things um like support and resistance or other range bound type indicators. I am not a fan of standard deviation in this case.
So I would say it's highly subjective. You ask 5 traders how they set up their Iron Condors, good chance you're going to get 5 different answers, listeners. Then support and resistance, also totally valid ways to go. But whatever floats your boat, listeners, that's how you set up your width. You want to get a little bit closer to the fire. Maybe you like to go, a little bit farther away from the fire, whatever your risk tolerance allows out here. Now, Dan, the question was about 0-day Iron Condors. And this is where things get interesting. Doing some of my own analysis, looking at some of the trading out there, talking to some of the brokers and seeing what they're seeing on the 0-day front. It does seem like Iron Condors have kind of jumped to the top of the pack again. We are seeing a widespread increase in adoption of them again. So apparently they are hot again with the 0-day crowd. And you can see why, listeners. If you come in, you can set your range, and then you could write your Iron Condor outside of that range. You know what your max risk is. You know what your max loss is. And it's not quite a set it and forget it trade, but it has elements to that, which I think for a lot of people is attractive. They have to just worry about that one big move that kind of takes away a whole week's or maybe a whole month's worth of profits out there and what you do in those. And again, when it comes to 0-day, there are other subjective ways people like to set their range. Some people like to wait a little bit. They wait for the first 15, maybe 30 minutes of the session, see what the kind of starting range is for the day, because obviously you're trading 0-day. You have a very finite window to trade these. They like to see what that day's early range is and then set their Iron Condor accordingly. So again, it's highly subjective out here. But Dan, what's kind of fascinating about doing this episode now is that we have more tools for our analysis. So it used to be, it was all 0-day SPX and Qs, and that's all fine. We've talked about that before. I want to go into some of these new products because that to me is kind of interesting. We have the newly listed, listeners, Monday and Wednesday weeklies on your Mag 7, your Apples, your Nvidias, your Metas, all that fun. So we thought these are new products, maybe still a little bit Wild West on the 0-day front. So they might make for some fun analysis, a little bit of fun digging. Who knows? Maybe we uncover some fun trades. In fact, one of these was kind of attractive. I was thinking about potentially putting it on if I could still get there by, it looks like Apple is still hanging out right in that range. Kind of interesting. Let's get to it. Listen, I mentioned Apple, and that's one we did this analysis on first today. We pulled these up before the open, so these are a whole full session worth of premium. These are off hours, I should say, markets, but these markets are still fairly tight, so didn't widen out enough to really ruin our analysis out here. So interesting stuff. We wanted to make sure we had a full session priced in, and it's hard to do these as a moving target right now, and you only have like half of a session left. Decay is flying fast and furious. So coming into today, Dan, with Apple right at 263 3/4, and again, it's hanging out 263.60 right now, so it hasn't moved much, at least net, from when we were looking at this morning. We decided to do the very standard way to do an Iron Condor, which is take that, at the money strike, which was at the time there is no 263 half strike. You got to go 262 half. And then look at doing some put spreads outside of that. In this case, we went 260, 257 half to the downside. In our example, you could sell that for about 30 cents. It was fairly rich. And to the upside, we went 267 half, 270 call vertical. Again, these are both 3 3/4 out of the money exactly. So it made them perfectly equidistant. And also, interestingly enough, you could sell that for 30 cents as well. So you could sell this Iron Condor in total, again, 3 3/4 out of the money for 60 cents, which is kind of interesting. These were $2.50 wide spreads that you were selling. So your max risk on this is $2.50 minus 60 cents. So $1.90, listeners. It's actually fairly juicy. This is why I was attracted to this one. We were talking about our example being about 43%, and that was maybe not that realistic, but at least today, Apple was pricing in some juice. Now, a couple of caveats to bear in mind. We're coming into this episode, we're rallying today, but we're coming on the heels of a big sell-off driven primarily by the war going on in the Middle East right now, vol popping. A lot of equities were selling off, so a little bit higher vol regime than potentially you might normally see in a zero-day environment. But still, Dan, 31% risking $1.90 to make 60 cents and being pretty far, nearly $4 out of the money. So your risk of hitting that, which, by the way, listeners, that at the money straddle was about only 2 3/4. So you're going $1 beyond that at the money straddle. So Dan, this one actually seemed fairly juicy. I thought about putting this one on myself. What are your thoughts about a 0-day straddle here today in Apple?
Well, I'm still calibrating some of the 0-day ones that are not the ETF ones. Those are the ones that I've looked at the most. But yeah, man, I mean, just looking at this, yeah, it does kind of make a lot of sense, doesn't it?
Fortunately, we have to do shows here. By the time I went in, I had obviously had to hit this one pretty quick in the morning to get that level of juice. Again, that's the downside of 0-day, listeners. Not quite there very quickly, like sands through the hourglass. It slips through your fingers, the decay, listeners. But interesting stuff. So at least for right now, Dan, I think we're 1 for 1 on the tasty 0-day Iron Condors in the single name equities. What do you think, sir?
Yeah. I wish I was, listening when you were talking about some of these things initially, I mean, geez Louise.
Let's see if we can do equally well with the big dog, Dan. Let's go out to NVIDIA. They are obviously the 800-pound gorilla in the AI battle right now. Their earnings are very much bellwether for the market. And coming into today, Dan, NVIDIA was pretty much exactly at 180, 180.05 to be precise. We're pretty much exactly at the 180 strike. And so we priced up, again, that at the money straddle was $3.65. And we actually went beyond that, and you could reasonably, because there are only $5 strikes in the 0-day contract so far in NVIDIA. There weren't 2.5 strikes. So you had to go a little bit wider than maybe you wanted. So we went to the 175, 170 put spread. Again, $5 out of the money, beyond the range of that straddle. You could sell that in our example for 32 cents. And then to the upside, the 185, 190 call spread for 20 cents. You could sell that Iron Condor for a net premium of 52 cents, a total premium, I should say, of 52 cents, listeners. Your total risk on this, obviously your spread is $5. The premium you're collecting is 52 cents. So you're risking $4.48. So not quite as good from a risk to reward perspective. You're only taking in about 11.6% of that risk there. Again, a lot of that has to do with the strike availability. There's $2.50 wide strikes in Apple. That gives you a little bit more nuance. Weirdly enough, only $5 wide strikes in NVIDIA right now. So that makes things a little bit more difficult. And right now, as we're talking, Dan, NVIDIA is 184.40. We are rallying today. So it is threatening to break into that 185 strike and that 185, 190 call spread, in which case it could take out a good chunk of that 52 cents. So this one was not as attractive to me for the reasons I laid out. And obviously in hindsight, it wouldn't have worked out. Potentially, if we stay here, it still would work out. But you're sweating a little bit more on this one, Dan. What do you think about NVIDIA?
Well, I mean, I think this is a good example of, again, the way I view the world with these kind of things is why the at the money straddle ends up, to me, not being the ideal way of doing it. Like, to me, it's better to look at historical ranges. I've actually been putting together an indicator that called the PAS bands is what they're called. I'm actually unveiling them in a webinar next week, where we look at historical context of ranges. It's kind of like almost like an average true range kind of thing, but different. And that kind of that kind of lets me look back and say what really is reasonable from price action, not basing it off, the pricing model, which I don't know. I mean, to me, should negate any benefit of any options position you can create that's based on that same option pricing model. I don't know, just me.
Yeah, I was a little more lukewarm on this one, and obviously that was borne out, especially selling that call spread for only 20 cents. It wasn't as attractive given the fact that there was a potential for an aggressive rebound today, which is exactly what we're seeing out here right now. So there you go, listeners. A bit of an overview, a bit of a refresher of Iron Condors. It is a great trading strategy. There are a lot of moving parts to it. You should be aware of all those. At the end of the day, it's a put spread versus a call spread, or one strangle versus another strangle. How you set it up, the width of that is key to the entire performance of the strategy. Again, there are a lot. You just heard several different ways and different viewpoints on how to set up your range for your Iron Condors. We were primarily leaning to the dark side, but you can flip this around and buy these as well. They are a cheaper bite at the apple, if you will, if you want to go that way. That said, the question was around 0 day. That's the lens we were looking at it for. And overwhelmingly on the 0 day front, these are being used to sell premium right now. There is some argument that maybe the over adoption of selling premium and some of the big index products has squeezed a lot of the juice out. Maybe they've been oversold out there, which is another reason why we looked at the equities. Right now, in the early blush, it does seem like there might be some gems worth mining out there in the 0 day equity front. I'm definitely going to keep an eye on some Apple Iron Condors, Dan, going forward. NVIDIA, I think they need a few more strikes so I could play a little more with a little bit more nuance. But in general, Dan, I'll have to give this a definite tentative thumbs up. I want to do some more analysis. I think we can come back to this. But in the early blush, Dan, I think there is something here with 0 day Iron Condor selling, particularly in the single name equities. What do you think, Dan?
Yeah, for sure. This is something definitely that is on my list to dig in. As people probably know, I've been doing a ton of work with 0 DTEs on the indexes and ETFs. So yeah, this is the next frontier that once I get some studying in on this, we'll be able to apply some stuff to it. And yeah, it's great. It's great.
Great indeed. You know what else is great, Dan, is that we're not quite done with, at least for the pro folks listening live. We'll be back in your ear holes instantaneously with the second episode of our double header. But before we go, Dan, if folks want more Mr. P in their lives in between episodes of Boot Camp, where should they go? What should they do?
Yeah, sure. I'll tell you what, if anyone is interested in my indicator for setting strikes based on tangible range-bound data, we're actually doing a webinar next week. Just go to markettaker.com/reg, markettaker.com/reg, and join us. I'm really excited to unveil it.
The nice thing about some of these trades, Dan, is they are very, very short-lived. I'm looking right now. I just pulled up Apple just to check. And with the stock almost literally unched, this Iron Condor has collapsed. You could buy the whole thing back for a couple of cents. So you don't even need to hang out the whole day, Dan. You can get while the getting is good, which is why a lot of people do like to take these off heading into the second half of the session, and then you go on about your business. So there is an attractiveness to that as well, listeners. These trades are obviously finite by definition, but then on top of that, they could be even much shorter in duration. So again, fascinating stuff here. Again, if you want to do any more deep dives into this, I know our friends over there at Tasty have a lot of analysis they've done in this space as well. Check them out. tastytrade.com/podcast is the place to go to kick the tires and light the fires. If you're hanging out in the pro, stay tuned. We'll be back instantaneously with another episode. Oh, congrats to Mackenzie for winning our pro trading crate. You can get your name in the hat for March, listeners. theoptionsinsider.com/pro. And we're back again next week for all you on-demand folks. Another episode of Options Bootcamp. Stay safe out there, everybody.
Old trading walks into a bar. New trading raises it. That's Tasty Trade. Keep focused with news feeds that matter. See opportunity differently in analysis mode. Chart your heart out with over 300 indicators. Plus, you can get low pricing, lots of education, and a support team that really gets how traders trade. It's no wonder Investopedia named Tasty Trade the best broker for options in 2024. Genius loves company. Go to tastytrade.com/podcasts and see for yourself. Tasty Trade Incorporated is a registered broker-dealer and member of FINRA, NFA, and SIPC.
You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play.